Yes, ma'am.
A very good morning to all the members. Today's session is really going to be interesting with respect to valuation rules under Income Tax Act. I request now Mr. TVS Prasad to formally introduce today's speaker. Meanwhile, I request everyone that 18th October is a valuation day celebration. So very soon the flyer will be circulated to all the BVA members. It's being hosted in Bangalore in ICMEI Institute. Over to you, Mr. Shiv-Prasad.
Good morning, friends. Yes, on this Dasara day, I wish you all a great success in the year to come, and in future also. And on behalf of the BVA, I wish you all a very great Dasara festival. And today, though it is a holiday, several of our members have shown their interest in attending this meeting, this webinar, the knowledge-based webinar, and I really appreciate their interest. Today, we have Mr. Ayush Goel with us to present a topic on the Valuation Rules and Income Tax Act, that's capital gains. Now, I take the privilege of introducing Mr. Ayush Goel to you all. Mr. Ayush Goel is a CA, fellow member of ICAI and the LLB. He has achieved notable ranks, including in All India ranking 39 in the CA finals and All India rank 14 in PCC with gold medals in CS and CMA. He is a designated partner at BAS and Company LLP, leading the direct taxes division, a mentor to startups and a visiting faculty at various institutions. Mr. Ayush Goel has conducted over 250 seminars and published numerous articles. This figure is very, very impressive. I think it is such a great achievement that only a few can achieve such a tremendous feat. And it shows his capability, caliber, and the knowledge levels. He through exam focus sessions. We are lucky to have such a enlightened personality to present a topic on capital gains. And as I already explained that he is co-opted a member of the tax committee of at the EIRC, that shows his knowledge levels. So we are fortunate enough to have him as the speaker for today. And Mr. Raj Goel, I welcome to you. And in case you are not a member of this BVA, I request you to become a member and let us be benefited with your knowledge. Thank you. Now it is over to you, Mr. Ayush Goel.
Sure. Thank you so much. Am I audible?
Yes.
Yeah. So
Yes.
thank you. And first of all, I thank BVA for having me here. And yes, a happy Dashera to everyone. As we all say that may in this Dashera all our evils and all our tensions gets vanished and we all get flourished with lots of happiness. So yes, a happy Dasha, and it's a very prestigious thing to be here on this day and to be able to share all these with you. Coming to the topic for the day, uh, it's basically, see, I'll give you a brief background why this topic was selected, or rather, why we need to and have an understanding of this topic. Because, see, all of you, I assume, are engaged in the valuation process in some way or the other. However, if we note that in various acts, the valuation rules itself are different. Yes, sir.
Ayush, may I request you to close the curtain because there is a light reflection.
Sorry, I'll do that. Is it okay now?
Other part also. Other part of the curtain also.
Great. Thank you. Yeah. So
Thank you.
coming back to what we were discussing, so in each of the different acts, the valuation rules are different, and so is the valuation requirements. Like if I take for an example, like at the time of maybe doing a rights issue, so there is a separate valuation rule as far as Companies Act is concerned, and there is a separate valuation rule as far as Income Tax Act is concerned. So similarly, Income Tax Act contains valuation rules at times of various stages as far as dealing of a capital asset is concerned. So the topic for today which we have selected is capital gains. So we'll be discussing about certain valuation rules which is applicable under the chapter capital gains of Income Tax Act. And notably, you might feel a reasonable difference with other valuation rules which you might have been kind of using it in your practical day-to-day bread and butter as far as say if you are dealing with valuations of Companies Act or any other valuation for that matter. So it will be may or may not be similar to that. So let us understand how it is in the Income Tax Act. Just a moment. I'll just right. So if we understand, see the valuation rules, if we have to say it in a broader sense, is covered under 3 or 4 valuation rules, namely Rule 11U, 11UB, 11UA, 11UAE, and 11UAA. Right? So we'll start off with the simpler ones. Let's understand 11UA first. So this is the oldest rule which is in existence. And let us understand what is the content of it so that we are able to understand. See, it starts with the heading, for the purposes of section 56 of the Act, the fair market value of the property other than immovable property shall be determined in the following manner. So section 56, however, does not pertain to capital gains. It pertains to income from other sources. If you have a detailed understanding, or if you rather happen to discuss about this detailed understanding, section 54 itself is contained in the chapter income from other sources and is not contained in the chapter capital gains. See, if we talk about this, if we go ahead in this and if we discuss, I'll just show you and then I'll read through it. The fair market value of unquoted equity shares for the purpose of subclause 1 of clause A of explanation to clause 7B of subsection 2 of section 56. Right? So if you have read through this, so this again talks about income from other sources. However, at the same time, why I am talking about capital gains and I am discussing about income from other sources, see, income tax depends upon a concept of deeming provision. So what happens is that supposedly if there is a transaction, then there is obviously 2 legs to a particular transaction. One is the person who's selling it and one is the person who's buying it, right? So for a particular transaction to happen, it will happen at a particular transaction value that will be same for both the person who's selling it and the person who's buying it, or rather the company who's issuing it and the allottee itself. So both the legs will be subject to the same transaction value, and it can so happen that the valuation rule is present for one of the legs and which will automatically apply to the other leg as well. So this particular valuation rule is such indirect application. Because let me give you a brief background of what is section 56 for that matter. So section 56 to the extent which we are discussing now is particularly telling you that supposedly I, say Ayush Goel, is selling a particular capital asset, say to Mr. B. So the valuation rule applicable to Mr. B in that transaction is contained here. So automatically, since the transaction value is common for Ayush and Mr. B, being the two limbs of a particular transaction, this valuation rule automatically gets applicable to Ayush as well in all practical understanding. Because Mr. B will not then like to deviate from this and pay unnecessary tax in his or her hand. So that's why this valuation rule, though starts with section 56, but is automatically applicable to a transaction of capital asset being sold to Mr. B or Mrs. B, who is otherwise covered under section 56. Right? So that's why this is again itself is important. So let us understand. Value of a property other than immovable property shall be determined in the following manner. So valuation of jewelry. The fair market value of jewelry shall be estimated to be the price which such jewelry would fetch if sold in the open market on the valuation date. Again, see, important. There are certain words which is required to be understood by us and which has its own meaning. So here the thrust is on the point valuation date, right? So we need to understand that on a particular day, if we are valuing it, or a particular day's report which you are signing, so we need to ensure that the and see the jewelry market price is I think you guys will be able to tell us better, but however it is based on the gold rate which is applicable for a particular day or for a diamond or whatever it is. So on that particular day of signing, you need to ensure that the value which you are taking is applicable on that date and not of a previous day even. So that is a challenge which is contained here, because the word clearly mentioned on the valuation date. Or rather, if you are supposedly, if you need to be doubly sure that, okay, I'm maybe signing on say 12th of October, but I need to refer to the valuation on 10th of October, then you need to very clearly mention in your report that the valuation date being 10th of October and the valuation as on 10th of October is this. Then you may sign on 12th, that is okay. But if you don't happen to mention these words, that the valuation as on this or the valuation date being this, it will automatically be presumed that the valuation date is your signing date. And then this particular clause will fail. Right?
So I
So
use
that
one confusion when we are talking about income tax valuation rules and all. Generally, there's
yes.
one confusion regarding the valuation date. Some people say the valuation has to be done with the audited financials. Now I know in regard to jewelry that is not applicable. But what I'm trying to say is that if suppose we are doing a valuation and the valuer is going to take the valuation figures audited financial for example 31st March 24. Now the jewelry, if there is some jewelry in that balance sheet or something, whether the jewelry valuation has to be taken on the current market price or as on 31st March 24.
See. So your point is clear, and that's why till the time you were asking this question, I opened another rule which we were going to discuss on a future time of today. But see, that is specifically related to the balance sheet, right? So the balance sheet in relation to a company, and see, it is for the purposes of this rule and rule 11 UA. So what happens? That's why I said that rule 11 UA specifically has certain words, which is again to be understood, and some of these words are again defined in rule 11 U. So for that purpose, let me tell you, for the purposes of sub-rule 2 of 11 UA, the balance sheet of such companies, the balance sheet of such company, including the notes annexed as drawn up on the valuation date, which has been audited by the auditor of the company, and where the balance sheet of the valuation date is not drawn up, the balance sheet drawn up on a date immediately preceding the valuation date, which has been approved and audited in the AGM of the shareholders. So from this particular second limb of this particular definition of the last immediately preceding valuation date, which has been adopted and approved, From here comes the definition or the concept of valuation on the last audited financials. So this is particularly applicable where the word balance sheet has been written. Right? It is not ordinarily applicable at all the scenarios.
Okay.
It is applicable where the word balance sheet has been written. And see, the valuation date means the date on which the property or consideration, as the case may be, is received by the assessee. So it ordinarily means the date of the transaction in case the transaction is being done, and in case the transaction is not being done, then in that case it means the date on which you are actually doing the valuation. However, in this valuation date concept, there is no concept of audited balance sheet or the last audited balance sheet. So in case of jewelry, you need not refer back to the valuation value of 31st March 24. It needs to be on the current date. I hope the query is clear to that extent.
Yeah, Ayush, thank you.
Yeah. So going back to rule 11 UA then. So that was the first limb again of the valuation of jewelry. The second part says, in case the jewelry is received by the way of purchase from a registered dealer, the invoice value of the jewelry shall be the fair market value, which automatically presumes the fact that the registered dealer is subscribing to the norms of valuation of their particular industry, and accordingly the invoice value is presumed to be the fair market value and shall be adopted as the fair market value accordingly. In case the jewelry is received by any other mode and the value of the jewelry exceeds 50,000 rupees, then the assessee may. So here is our, see, we need to also understand that there should be a basic background objective of behind anything which we are learning or anything which we are kind of absorbing, because on this fine morning, if we are understanding something, we need to also understand, so where does a professional opportunity from this may be understood. So see, the professional opportunity for us as valuers is where the value of the jewelry exceeds rupees 50,000, then assessee may obtain the report of registered valuer in respect of the price it would fetch in if sold in the open market on the valuation date. So now this is a, if I have to say, this is a very open pond where we all can have our own share. We need to make our clients understand that yes, at the time of sale of a jewelry, or at the time of maybe if they need to have a will or anything for that matter, whatever it is, the valuation of jewelry to that extent becomes important, and maybe and the report be obtained from the registered valuer. Though it is a may here, it is not mandatory under Income Tax Act to that perspective. However, see, in income tax, one more thing which you need to understand now, wherever there is written a may, it as per law there is a understanding that it is not required and it is optional. But whenever a follow-on assessment or an inquiry is done, then this particular valuation report is the first thing which is being asked. So even though it is a may, it is always suggested that wherever a may is written, it becomes a shall in the mind of the assessee, and that particular thing is done to avoid any further issues which might crop up with respect to that particular transaction. So that is how income tax in that understanding of assessments and litigations work. So even though it is a may, you need to make a client understand to avoid any further litigations or any issues during the further litigations. This may be read as a shall in the mind, and that valuation report be obtained and kept in safe custody for any further, if I have to say, any further showing it to any further authority, right? See, so this is what we discussed about jewelry. Similar things have been written about any archaeological collections, drawings, paintings, sculptures, or any work of art. The fair market value on the valuation date, artistic value, if you buy a registered dealer, then the invoice value, and if any other mode, then may obtain the report from the registered valuer. Now coming to clause C, which talks about valuation of shares and securities. So first we will deal about the simplest one, which is the quoted shares. The fair market value of quoted shares shall be determined in the following manner, namely, if the quoted shares and securities are received by way of transaction carried out through any stock exchange, the fair market value of such shares and securities shall be the transaction value as recorded in the stock exchange. So goes without saying that the stock exchange is the primary source of the fair market value. So if any transaction is carried out through the stock exchange itself, then the fair market value is deemed to be the value of the transaction at which that transaction is recorded. Right? However, if such transaction quoted shares are received by way of transaction carried out other than the stock exchange, the fair market value shall be the lowest price of such shares and securities quoted on any stock exchange on the valuation date. Again, we need to understand two things. One is the lowest price, right? And second, if there are multiple stock exchanges in which it is listed, then we need to check all the stock exchanges and the lowest price applicable should be taken as the fair market value. If the shares have been traded on that particular valuation day itself, and if it has not traded on that particular valuation day, because see there are multiple shares which is traded say once a month, once a week, or any other scenario, if it is not traded on that valuation date, then the date immediately preceding the valuation date when such shares and securities were traded on such stock exchange, in case the valuation has not, I mean, in case no trading is done on that day. So if the trading is done on that day, then the lowest price of all the exchanges on that day. If not done on that day, then the lowest price on the of the day of any of the previous day in which such trading has been done. Right?
Yeah.
Now coming to the second part, which is the fair market value of unquoted shares on the valuation date of such unquoted shares is determined in the following manner. So we have talked about quoted shares. Now we are talking about unquoted equity shares. So remember, there is again a difference, and this is important to note. While talking about quoted shares, there is no particular differentiation between quoted equity shares or quoted any other securities or anything. So it covers about all quoted shares and securities. However, the second part which we are talking about, the unquoted part, we are starting off with unquoted equity shares only. So this is again a difference which you need to keep in mind. While talking about quoting, all the quoted shares and securities will have the same valuation rule. However, for the unquoted shares, first we'll deal about the unquoted equity shares and then we'll move on to the next part. So as far as unquoted equity shares is concerned, this particular formula needs to be kept in mind. A plus B plus C plus D minus L into PV by PE. So you might be then telling that, okay, now we have moved into a maths zone. No. So this is a particular formula which has been placed by the income tax valuation rules. However, if we need to understand, it's very simple and let us understand how it is. So A, rather than talking about A first, let's talk about B, C and D first. And A is basically the residue. See, here the word balance sheet is used. So then the concept of balance sheet which you have seen in rule 11U, let me do a good thing. Let me just open a comparison. Right. So this balance sheet definition which you have seen here will be applicable to this particular thing. Fair market value of unquoted shares. Why? Because here the word balance sheet is referred. See, balance sheet as reduced, right? So coming back, as we talk, we'll talk about A later, but first we'll talk about B, C, D, and L. So B is the price which the jewelry and artistic work would fetch in sold in the open market on the basis of the valuation report obtained from the registered valuer. Right. So again, the valuation rule of jewelry which we have discussed earlier. However, in here the word may is missing. So again, a professional opportunity for all of us. The price of the jewelry and artistic work would fetch in the open market on the basis of the valuation report obtained from the registered valuer. So here the valuation, because see, it is not sold, there is no transaction value, there is no invoice per se. We are doing a valuation only to obtain the fair market value of the unquoted share. So here the valuation report becomes important because there is no other reference point. So the reference point here then becomes the valuation report from the registered valuer itself. So that is important. Fair market value of shares and securities as determined in the manner provided in this rule. So it's like a loop. Supposedly there is a share of say XYZ Private Limited. From XYZ Private Limited, you see in the investment there is another share of ABC Private Limited. And in the if you go into the balance sheet of ABC Private Limited, then there is another share of say EF Private Limited. So first you have to do the valuation of EF Private Limited, find out the valuation of the share of EF Private Limited, substitute it in while calculating the value of ABC Private Limited, and then use the value of ABC Private Limited in the valuation of XYZ Private Limited, which is your assessee for that matter. Now the question which might ask is key in this particular chain, how far do you go? Because there might be a scenario that there is a cross referencing or a cross holding or a situation like that. There are multiple levels of holding. So where exactly do you stop yourself? Because otherwise it will become a practically non-viable task. If you keep on digging and continuing till the grassroots level, it will become a non-viable or a non-practical task for that matter. So for that, I'll probably have your suggestions. Any of you, if you like to tell that on a practical scenario, because you guys are more into this zone of valuation and into this era of valuation. So as a practical purpose, how do you take care of this scenario? Because this scenario might also arise in Companies Act or for that matter, any other valuation which you're doing. Because there might be a cross holding, there might be a step up holdings at multiple stages. So how do you take care? Matlab, is there a valuation? Like in income tax, we generally follow a 3-step down model. Like we'll go down up to 3 levels and then we'll stop. So is that a similar thing which is adopted at other acts or other valuation zones, or how is it?
So I think it's as per the discretion of the valuer. There's nothing specific. I think it's not specified in income tax as well as the Companies Act. At the discretion of the valuer. I think, like you said, that 2-step and 3-step, same thing is, I think, applicable in other valuation rules also.
Yeah, exactly. So that's why the issue is because nothing has been prescribed and we need to take a practical approach. So as rightly said, maybe 2-step or 3 steps. That's how we need to take it up here as well. Because while talking about the valuation rule, the part C itself talks about the valuation of other shares as per this rule itself. So again, you understand going into the loop. So we need to understand about that thing. And D is important. The value adopted or assessed or assessable by any authority of the government for the purpose of payment of stamp duty in respect of immovable property. So wherever there is an immovable property, you need to take the fair market value being the value adopted or assessed or assessable by any authority of the government for the purpose of payment of stamp duty. So basically we have to say stamp duty value. However, in this particular point, the requirement of valuation report is not there. It simply says that the value means if there is any evidence of the value to be adopted or to be assessed by the government authority for the purpose of stamp duty, that itself will suffice.
Is it guideline value, sir?
Sorry,
Is it guideline value?
I couldn't get you, sir.
Is it guideline value? Guideline value.
See,
Guideline.
You should
I
have
don't.
guideline valuation. Like there's some property
Yeah.
value as per the guideline.
I'll tell you how it is obtained. Like, I'm not sure how it works in Bangalore for that perspective. However, in Calcutta, or say for that purpose in West Bengal, there is a concept of a West Bengal registration authority, which tells us about the stamp duty value of a particular immovable property as on a particular, or which we call here in normal circumstances a query sheet. So we kind of put in the valuation, the property details at a particular means authority's website. We then there are queries being derived from that particular website containing the details of all of the property and the stamp duty value as on particular date of the query which is being fetched, which is used for all transactions of sale as well. Whenever we sell the property, the query sheet is to be attached and the stamp duty is calculated based on that query sheet and the stamp duty is paid accordingly. However, that query sheet can be obtained with or without the necessity of the sale to happen. So I think a similar situation will be there in
I have a doubt here.
yeah.
In one of the case, okay, the guidance value is much less than the book value.
Okay.
Say, for example, 1 crore is the value of the property as per the stamp duty calculation method. Okay, 1 crore is the value of the property, but then in the books it is recorded as already 5 CR, 5 crore.
Okay. Okay.
So what should I take?
Now then, in that case, first you need to assure yourself. See, there might have been a development on that property, or there might have been any other cost which has been incurred. So first you need to ensure.
Nothing like that is there.
So all that thing has been accommodated in the query or the guidance value which you have derived or not. So
Yes, everything is already there.
So if everything is means everything has been done, then as per this valuation rule, you can only take the fair market value. Because see, with immovable property, we have this notion in mind that it should obviously increase. How can it has decreased? Because that is a general perception which we have. Ki 5 crores, the value was there, so how it can be 1 crore. But however, this question will not arise in your case if you are dealing with a motor car, right? Because in motor car, the book value might be 5 lakhs, but the fair market value is say 1 lakh, because it is a depreciating asset. However, we have been told, or we have been presumed in our mind, because of this valuation theory which is going on, that the particular property of means immovable property always appreciates true to its normal scenario, but there can be a scenario where the value has also depreciated. You need to understand first in discussion with the client that why this thing has happened.
Guidance value and purchase value will definitely be different, no, in that context. Not every transaction happens at guidance value.
I'll tell you, ma'am. I understand your point. It will be different, that is for sure. But in ordinary circumstances, the guidance value will be more as we move ahead in time as compared to the purchase value, which is the ordinary circumstance. However, in your circumstance, the guidance value has reduced, if I have to use the word drastically or reasonably, from the purchase value. So then you need to see, here is where the practical approach of a valuer comes in place. You need to understand from the client that why such scenario has happened. I'll share you a very practical scenario, and this is very practical. Tell me if you guys can be able. See, I have a plot of land. I own that plot of land of say maybe 4 bighas or whatever it is. Now I need to build in a very large project. For that large project, I need another 4 bighas of land. Now there is an adjacent property to me or adjacent land to me of same 4 bighas. However, the fair market value of that 4 bigha is say 2 crore rupees. But the person who is owner of that particular 4 bighas knows that I am in requirement of that 4 bighas and he wants to charge a premium on that. He says that no, I will not sell you that 4 bighas. I'll sell you that 4 bighas only for 4 crores and not for 2 crores. Now I know that until unless I obtain that 4 bighas, I'll not be able to have a adjacent or a common 8 bighas of property, and my project will not develop and I'll otherwise make losses. So I pay premium to that person and purchase it at 4 bighas, at 4 crores. So in that, even though there is a means the guidance values of 2 crores, but I've purchased it for 4 crores. So you need
In
to
that case,
understand.
what should be considered here?
Sorry?
In that case, in that scenario, what should be considered here as the
You need to mention in your valuation report that you are taking the purchase value because of this scenario. So that's why see, once you have a guidance value, once you have a purchase value, and once you kind of compare, then you go back to the assessee or your client to understand why this not so ordinary decrease in the guidance value. If he's able to satisfy you with a reasonable understanding, then I'll suggest that you can obviously put in a step forward and write with a particular reasoning that why you are taking the purchase value being the higher value and not the guidance value.
Suppose there is no specific reason, then I understand. I got
If
your
there's no
point.
specific reason, then as per the law, you have to take the guidance value.
No, but
I
as long
tend
as
to
we are
agree with you, Ayush.
no, madam. See, as long as we are sure that the previous transaction was done at a arm's length and at a market price, there is nothing wrong in taking that 4 crores in this example. No, we should not take
Agree.
we
And
should not
in
take the circle rate, because we are 100% sure that the previous transaction in this example what he gave also, it is at an arm's length. It is not to boost up the price or something. Suppose same thing happens in Bangalore also. What happens is that when the guidance value is say 1 crore, the market price is going at 2 crores. Suppose last year it bought at 2 crores. Today we are doing a valuation. Today it will be still 1 crore only. But actually he bought at 2 crores, which is a fact, which is at arm's length only. No? So, and the objective of this income tax rules also is that we should arrive at the fair market value. So,
yeah, so very rightly said. So if you are able to determine that he has maybe bought it because of demand. So in the same example as I said, if it is out of a demand, if it is out of his requirement and his purchase at a higher value, write it and put in 2 crores. However, like you said, that if you're not able to justify it for any reason, then the answer remains that you need to obtain the guidance value. Means you need to adopt the guidance value. However, if you are able to justify through any means, like it may be because of a demand of a particular locality, like suddenly this locality has become one of the if I have to say IFSC, or for any matter any particular good thing has happened, or a statue of unity has been erected just near this particular property. So this property's value suddenly has dwelled up and you are purchasing it because of the demand, say Ayodhya for that matter, but Ayodhya's guidance value may or may not have been increased as of now. So then you can substantiate that because of the demand you have purchased it at a higher value. So you can write and use the book value or the purchase value in that case. It is not a harm. So yes, as we talked about this, A plus B plus C plus D minus L.
Sir, actually, sir, sometimes, sir, not only the book value, suppose the current transactions are slightly more happening more than the existing book value, then can we take the market value instead of this one, fair circle rate?
No, sir. So in this, then there is only two options. One is your purchase value, and one is the guidance value or the stamp duty value. The third
can't
option
take
of the market value is not there.
Okay.
See,
Okay.
in the rules, it is not there.
Rule,
Now,
but then but then what happens in the market also is that supposing he bought it for, see, in Bangalore at least the guidance value is always lagging behind the market value. Suppose today I have to do a transaction at this rate, it will definitely be the more than the guideline value only. Can't we justify that and then write it there?
I
Otherwise,
understand.
see, otherwise what happens is
I'll
that my
share your
valuation
query
actually is
with
coming down.
I'll share your query with an example, sir. Supposedly today I brought a property at 2 crore, my guidance value was 1 crore. After 1 year, the property's value has changed from 2 crores to 3 crores in the market. However, the guidance value has remained at 1 crore. So now what value will you adopt? 1 crore being the guidance value, 2 crores being the purchase value, or 3 crores being the market value?
3
That is your
crore.
query?
Sir, 3 crore.
No. So see, now that is a, if I have to say, that is a issue of the Income Tax Act, because Income Tax Act goes by the words or by the law which is contained in the act. For a
Sir, income
practice.
tax, sir, 1 minute. I think in your case, income tax is objective is to collect the taxes. Sir. When a guidance value is 1 crore, purchase price
Sir,
is
the
2 crore.
object, I'll tell you, the object is a different thing, and the law which is contained is a different thing. The object, you need to prove it beyond a certain doubt, and then only it will
Sir,
be.
Sir,
I'll tell you the reverse example.
Sir, 1 minute. 1
Shared
minute.
about.
We have a different view. Always we go with the principle in the objective and this and purpose of the law. Now, in this case, do you have any precedence? I don't agree that when a market value person is offering 3 crores, if a guidance value is 1 crore, purchase price is 2 crores. I don't think that value is 1 crore.
So
Even
what is the document for that 3 crores?
Sir, yes, accepted. Yeah, that's what value is taking responsibility. Management is accepting. See, guidance value property.
We are taking a valuation report for this higher rate, no?
Correct.
And there are transactions which are happening in recent times.
Sir,
No, sir.
sir,
So
for a
see,
while, also, sir, for a while, even if you don't take if the valuation report gives you say 1.5 crores, sir. If you're offering 2 crores, I don't think there is an issue, because your value should not be less than the valuation report. Valuation report is going to principle. I think. Do you have any precedents such cases? It goes in the
Ayushi,
purpose.
the thing is the guidance value is actually different and market value is different, at least in the state of Karnataka. Guidance value is every few years the government actually, depending on the area, it fixes the price and it says that below that price you should not do a transaction.
Yes,
correct.
So and market value is totally dependent on market forces.
See, let me kind of summarize it for the better understanding of the audience. See, 3 things we need to understand. Like you're telling about Karnataka, in Bengal or in Kolkata for that matter, we are on the other side of the table. For us, the guidance value is always on the higher end, and the demand value or the transaction value is always lower. So we also face the same scenario in a reverse mode, in a mirror mode. However, as far as income tax rules are concerned, income tax rule for that matter clearly, and please mark my words, clearly state the value adopted or assessed or assessable by the authority of the government for the purpose of stamp duty. So that is the second part which we have discussed. Third part, which I need to tell and which will probably summarize everything. As I've initially mentioned while sharing that example of 4 crores as well, that the role of a valuer is to have a practical step down or a practical veto on this thing and probably mention it with all the reasonable authority in that valuation report. However, having said that, the income tax authority will go by this valuation rule. If you are able to satisfy that particular authority beyond a reasonable doubt that what you are telling is correct, then there is no issue. However, then the onus will lie on you or the assessee to establish the contents of that valuation report being true and just. Now, the query which I have raised upon you is based on my practical experience that what is the authenticity of the market value? You have told that it is based on a valuation report.
Sir, 1 minute. Authenticity is, in your same example, when I am offering 4 crores for the tax, valuation report is for 2 crores, guidance value is say 1.5 crores. No, I don't think anybody agree when what authenticity is required. Authenticity is required when I'm deviating when when a valuation report is for 2 crores, when I'm offering for 4 crores, is set within if it can be reversed, I cannot offer. I don't think that view is correct. What's the authenticity? Sir, authenticity is required when you doubt the transaction. In this case, there is no doubt. He's right trial is offering for the tax.
If
Or
you're
just a document.
sir, I'll tell you. You are telling you are offering for tax, but I told you now there are two limbs. In this case, if you adopt the higher value, the value of the share becomes higher. Am I correct?
Correct, let it happen. It goes for cost of
So
acquisition more.
let me complete my example, sir, and you will understand where the query will come. So based on that 4 crore value or the higher value, whichever we are discussed, based on the market value, say the value of share has come up to 100 rupees.
Correct.
Okay? If we would have taken the book value, the value of the share would have come to 80 rupees. So you are telling that we are putting in higher value, right?
Correct.
Now, I being the recipient of that share,
Mm-hmm.
my value is 100 and I have bought it at say 102 rupees.
Okay.
And the difference is taxable in hands of the purchaser under section 56.
Agreed, sir. Now, as you said, if the value, if you adopt the guidance value, 20 rupees is our share price. If you adopt the market price, share price is 100 rupees. So 56 to 10 is not applicable because he's not.
Then the assessing officer will challenge you that why it is not 80 and why 100.
No, where is it, sir? When you accept the higher value, same thing is the purchase price only. He is already paid, no? It cannot be.
No, it's not. See, you are paying 100 rupees. That is okay. I am telling about a scenario where the fair market value is still higher. See, the query is different. If you have paid 100 rupees and there is no difference, if the government is not at loss, there is no revenue leakage, then the question is not arise. Then there is no query. Then it's okay. Then it's the matter is closed. I am telling about a scenario where there is a difference. Understand my point.
So how can we different comes when I'm offering when a 2 crores is the value when I'm offering 4 crore?
Sir, if there is, because see, we have other points to discuss. I'll very humbly like to close it with one closing statement. If there is no difference, it's good for you and it's good for the assessee as well, because then there will be no issue. My only contention is that if there is a difference, then you need to be doubly sure. Or if now your question is how will there be difference, then that depends on a case-to-case basis. However, if there is no difference, then the question itself is not arising, and then whatever you are doing is correct. However, if there is a difference, then the onus lies on the assessee to prove what he has adopted, because the law states about the government authority and the stamp duty value, and you have adopted a different amount to that perspective, then the onus lies on the assessee. So that's what my humble submission is. Moving ahead, see, we talked about B, C, and D. Now coming back to A. So A talks about the book value of all the assets other than what is discussed in B, C, and D in the balance sheet as reduced by. So all the other assets other than the jewelry, the shares, and the immovable property, in that case, we will take the book value as reduced by any amount of income tax paid, if any, the less the amount of income tax refund claim. So any taxes which is actually paid and not refundable will not be considered in the assets, because it is actually not an asset, it is an expenditure. Any amount shown as an asset, including the unamortized amount of deferred expenditure, which does not represent the value of an asset. So again, a deferred expenditure is also an expenditure, not to be treated as an asset. So these two will be removed and the book value of all other assets. And there is a minus L. So minus L talks about the book value of the liabilities shown in the balance sheet, but not including the following. Right? So book value of liabilities not including the following: paid up capital of equity shares, amount set apart for payment of dividend on preference shares and equity shares where such dividend have not been declared before the date of transfer at a general body meeting. Reserves and surplus, by whatever name called, any amount representing the provisions for taxation other than the amount of income tax paid, if any, less the amount, similar to that, the provision part, the liability part. Any amount representing provisions made for meeting liabilities other than ascertained liabilities. So any provision which were made out of unascertained liabilities, because again, then that is not a liability, it is part of profit as well. Any amount representing contingent liabilities other than arrears of dividend payable in respect of cumulative preference shares. Again, this contingent liability is only to be reduced if it is forming part of balance sheet. If it is not forming part of balance sheet, it will not be reduced. Right? Because the word again starts with shown in the balance sheet, but not including. So this contingent liability, don't get confused that even if there is a outside contingent liability which is not in the balance sheet, then that will also be reduced. The answer is no. Only if it is contained in the balance sheet in the liability side, then it will be reduced. PV is the paid up value and the P is the total amount of paid up equity capital. So that is just for the calculation. So understand the concept, how are the assets to be taken where, in case of a equity share valuation unquoted, and the fair market value of unquoted equity shares other than equity share, unquoted shares other than equity shares in a company which are not listed in any stock exchange shall be estimated to be the price it would fetch if sold in the open market on the valuation date, and the assessee may obtain a valuation report from a merchant banker or an accountant. So see, merchant banker we all know. For the accountant, just hold on. See, the accountant word has been removed by the, see, that's why I'm showing it. Is it visible, this clause A?
Yeah, visible.
Yeah. So up till 24/5/2018, accountant ordinarily meant a chartered accountant who's means who was authorized under ICI, right? However, this has been removed. So now an accountant for that matter includes member of any accounting body who's a qualified accountant under any accounting body is qualified to give a report as an accountant here. Earlier it was restricted to ICI, now it has a wider application and can be done by any particular accountant. However, the accountant doesn't mean an ordinary accountant who is doing the tally entry. An accountant is a person who's qualified as an accountant. It can be a chartered accountant, it can be a CFA for that matter, it can be a any particular person who's qualified as an accountant. So what we have discussed for equity shares, this particular A plus B plus C plus D minus L, where we talked about the jewelry valuation, we talked about the shares and securities, we talked about the immovable property. For all other assets, the book value less the liabilities, which again is at the book value. Then we talked about the concept of the balance sheet. And for other than equity shares, unquoted, it will fetch in the open market based on the valuation report of a merchant banker or an accountant, right? Now see, there is this part of the fair market value for the purposes of subclause 1 of clause A of 5627B. Why I'm skipping this, I'll tell you the reason for this. So if you understand, in this particular budget, the last budget which was introduced in July 24, this particular section has been sunset or has been kind of made inapplicable, the section 5627B, talking about the fair market value in case of issue of shares by the company. So since this section itself has been made inapplicable going forward, this particular valuation rule itself will not have any relevance in the future, because this particular valuation rule, as you see, deals with only this specific clause of 7b of subsection 2 of section 56. So since this 56 to 7b itself is now not applicable, this particular valuation rule, both see part B also talks about this. 7b of subsection 2 of 56. So that's why this particular sub rule 2 of rule 11 UA itself does not form any relevance going forward. So the third part, where the date of valuation report by the merchant banker for the purposes of sub rule 2 is not more than 90 days. Again, since it talks about sub rule 2, which itself is not applicable, we are skipping this part as well. Any query on that? Great. So now talking about rule 11U, we have talked about the balance sheet. Then it gives a definition of merchant banker, which is category 1 merchant banker registered under SEBI and all that. Quoted shares means one which is, so these contains the definitions which is used in rule 11 UA, right? Recognized stock exchange, registered dealer, registered valuer shall have the same meaning as assigned to it under section 34 AB of the Wealth Tax Act, read with rule 8A of Wealth Tax Valuation Rules. So I think most of you guys will be registered under that particular rule. Securities, unquoted shares, and valuation date, which you have again discussed. Yeah, so now coming back to what we were discussing about the other valuation rules. See, there is this another valuation rule which I like to discuss, rule 11U AA. So see, there is another section called 50CA when we are selling. So that, see, 56 talks about the purchase limb. Now we are talking about the selling limb, the person who's selling those shares. So the person who's selling those shares, for them there is a section called 50CA which talks about the fair market value at which such shares should be sold, right? So there is a valuation rule, rule 11 UA, which talks about that. Why it is simple, you will understand when we read out. For the purposes of section 50CA, the fair market value of share of a company other than a quoted share shall be determined in the manner provided in subclause B or subclause C to the case may be of clause C of subrule 1 of rule 11 UA, right? So let us understand what it talks about. Let me again use a comparison for that particular purpose. Just hold on. It's not blinking. See, it talks about this clause, this particular thing. Clause B or clause C, which we have discussed already. So this is what is contained in rule 11 UA AA as well. Subclause B or subclause C, as the case may be, of clause C. So 11 UA, clause C, subclause B or subclause C, which we have discussed just now. So that itself is contained on the seller's limb as well, right? Great. So now going ahead, another important valuation rule. See, we all know, and again, this is a very important professional opportunity for all of us. Why? Because nowadays, in this era where there is a lot of startups happening, or there is a lot of entities who are changing their organization to the expecting they're purchasing companies, they're purchasing businesses, they're selling off their businesses. This concept of slum sale is very important as far as income tax is concerned. It is contained in section 50B, capital B of Income Tax Act. So earlier there used to be no particular rule for the sale of assets under slum sale. It used to be done at the book value, and then there was a lot of revenue leakage which used to happen. So having understood that concept, in 2021 this valuation rules in respect of in respect of slum sale has also been introduced. So this again forms a very important professional opportunity for all of us, wherein we can put in our valuation report into perspective. So this talks about, for the purposes of clause 2 of subsection 2 of 50B. Again, this talks about the, if I have to say, the slum sale, the fair market value of the capital asset. Again, this is restricted to the capital assets, not the inventory and everything. So inventory and everything will be taken at the book value. However, for the fair market value of the capital assets shall be the FMV1 determined under subrule 2 or FMV2, whichever is higher. The word used is whichever is higher. So it itself gives two options, and then you need to compare, and whichever is higher, you need to adopt that. Right? So FMV1 is what we have discussed just now, which is A plus B plus C plus D minus L. B is the jewelry artistic, C is the shares, D is the stamp duty value of the immovable property, A being the book value of all other assets. The word is slightly different here, as appearing in the books of accounts of the undertaking or the division transferred by way of slum sale. It doesn't talk about a balance sheet or something like that. It talks about the day on which it is to be transferred, the day on that when the books of accounts are drawn, the book value as on that date. There is no concept of balance sheet here as was contained in Rule 11 UA. So that is the difference. And L is again the book value of the liabilities as appearing in the books of accounts. So this. And then there is another example option of FMB2. So FMB2 shall be the fair market value of the consideration received as accruing as a result of transfer. So there was this A plus B plus C plus D minus L. Then there's another formula E plus F plus G plus H. So today we'll all learn all the probable alphabets. So this is another. E is the value of monetary consideration received or accruing as a result of transfer. So when we are transferring this as this particular undertaking under slum sale, the consideration which we are receiving, that is E. F is the fair market value of non-monetary consideration received or accruing as a result of transfer, is represented by property referred in subrule 1 of Rule 11 UA, determined in the manner provided in subrule 1 of Rule 11 UA. So supposedly, if you are receiving a cash consideration plus you are receiving another property in lieu of the undertaking which you have sold, then the valuation of that property in terms of this particular methodology, the stamp duty value, so that needs to be added to your consideration. F is the fair market value of, sorry, this was F. G is the price which the non-monetary consideration received or accruing as a result of transfer, represented by property other than the immovable property which is not referred in subrule 1, would fetch if sold in the open market on the basis of the valuation report obtained from a registered vendor. So if there is any other property being other than immovable property, then its fair market value as per the report of the valuation officer, that again needs to be added. So example, supposedly if you have received a cash consideration and maybe if you have received another shares, so then that shares will be valued by the registered valuer and its value will be added to the monetary consideration which you have received. Right?
Yeah.
Sorry. So there is a bit of difference which I've told. That immovable property thing is contained in H, and F talks about the valuations of items which is covered under Rule 11 UA, and G is for the other items not otherwise covered under 11 UA and which it would fetch in the open market. Is it okay?
Yeah.
So there are 4 parts. E is the monetary consideration. F is other than immovable properties like shares or archaeological consideration or anything whose valuation report is rule is contained under 11 UA. Then as per those valuation rules, if any other asset is received, then the value it would fetch in the open market. That has to be added. And H is for the immovable property. The stamp duty value needs to be added. So E plus F plus G plus H, this will be added, or the first part A plus B plus C plus D minus L, whichever is higher, will then be seen as the valuation fair market value of the undertaking which is being sold under the slump sale. So how and why this 2 limbs? The first A plus B plus C plus D minus L is what is being given. It's fair market value, and E plus F plus G plus H is what is being received. It's fair market value. So we'll compare both the parts, and the higher of the two will be taken as the fair market value of the entire transaction. Are you able to understand how this FMB1 and FMB2 has been placed? One sees the value of the assets which are being given, and one sees the value of the consideration which is being received. So the higher the both the things, the one which is higher will be taken as the fair market value.
No, I have a question. Like for FMV2, how do you treat contingent consideration or earnouts where like consideration is paid later? Do you need to take a practical view and value as on the date of the transaction?
The contingent consideration will obviously be contained in the agreement of sale which of the undertaking. What I understand by contingent consideration is supposedly that you say that okay, if you transfer me this license, then only that 1 crore will be paid. Example, one of the examples of a contingent consideration. So to my understanding, again, yes, what you have said that a practical view needs to be taken is correct, but that is part of a consideration and should be included until unless there is a reasonable doubt that the situation on which the contingency is dependent will not be happening.
Okay.
See,
Thank
if the probability of not happening is more than the probability of happening, then obviously you need to exclude it. Otherwise, for all probable reasons, that needs to be included.
Okay. Thank you.
Yeah. So that was the part of the valuation rules as far as slum sale is concerned. And with this, so these were the as far as capital gains is concerned, these were the major limbs. We could have discussed more about that 56 to 7B, but however, since that has been withdrawn, I'll think in the best interest we'll not discuss that, because now effective this October, that is otherwise not applicable to all of us. So with this, I rest my deliberations. I think we are open to any kind of suggestions or queries, and then otherwise we can just enjoy the holiday and have a great day ahead.
Mr. Ayush, can you share any practical case which you have handled, which will give us a more comprehensive view about the entire topic?
Like, see, the practical cases which we have handled to that extent was majorly one with respect to 56 to 7B. Then with respect to 50 CA, like the practical example which we discussed about this stepping down process. So like one of our clients, what happened was that they were selling their entire shareholding because there was a change of management which was happening. So in this change of management, a major chunk of their shareholding was being passed on as a sale to another organization. In that particular thing, what was happening, it was going as a bunch of companies to the other organizations. So in one of those companies, there was a multiple level of cross holdings or multiple level of shareholdings which was there in a particular company. So there was a query which was raised because obviously there was a huge amount involved. There was a query raised, what is the fair market value? So in that we had to prove that this stepping down process. So we had to show them that we had taken up to 3 levels, and beyond the third level, since the holding was getting less than 10%, we could not have taken it beyond a certain point. So these are various cases which we have dealt. Then about the fair market value of immovable property, there was cases, but that was not much of a litigated ones. However, what we have discussed in this forum, if that is a scenario, I can understand that we need to put in that practical approach, and then the uh, particular, it will become a good case study for all of us. Apart from that, there is not much things happening in income tax as far as valuation rules are concerned.
So see, I have a question here. Like,
Yes,
see,
sir.
like leasehold assets or
Yes.
right to use assets. Okay. So
Yes.
should we consider them as immovable property, or like sometimes we give a note saying we are treating that as intangibles because it is classified as intangibles in the balance sheet. What is your view on that, sir?
Sir, very apt question. But as far as income tax, again, income tax is concerned, Income Tax Act only considers freehold land as an immovable property. Otherwise, what you have said, any right on a leasehold property is considered as a right to resale or a right to use or a right to sublease or whatever you call it, based on the agreement which you have made, and will obviously be classified as an intangible asset, and its valuation is not determined by the government valuation, and it is open to the valuer to obtain its valuation as it would fetch in the open market. That is its resale value. So it will be classified as an other than immovable property, not an immovable property.
No, but sir, in that case, supposing there is a company which is a toll road company, all the toll collection rights are considered as treated as intangible assets only in the balance sheet. No, then how do you deal with that?
So you need to then understand what is its price. Supposedly, I am a company having a toll right of a particular toll. Now, if today that toll right I want to sell it to you, so what is the price it would fetch me ordinarily without any particular means what you say assistance or without any particular pressure? What would do, or if you call it arm's length price, what would be its arm's length price in the market? That is its price. So
That
that
is
as
like that is like a discounted cash flow only then, because there is
yeah,
only toll collection which comes over a period of say next 10 years.
100%, sir. DCF is a very practical approach since there is no particular valuation rule which has been prescribed. DCF is the most practical thing to obtain because obviously the company also otherwise will not be able to know at upfront what will be fetched.
No, but our revenue is speaking about balance sheet and that method, no, not the DCF method. So how do we reconcile that with this?
Sir, Ravi Shankar, sir, I have a different view.
Yes, sir.
In case of Rule 11 UA, we don't have much rule. In fact, strictly speaking, there is no valuation report is required. This is only summation of amounts on the balance sheet. What we must do is take balance sheet values of all the assets except 4: land and immovable property, jewelry, or the archaeological list. Other than that, we should not do intangible. Let it be intangible assets, SFA, anything. You take book value of assets. These 4 values replace market value of the book value, similar to liabilities. I think Senthil's question, intangible assets, right to use, though it is right to use, but we don't recognize any DCF. We should recognize only balance sheet. The act is very clear. Take book value of all assets, replace these values. So that's what my view is.
So
Sir,
that means that
adding to your
intangible asset you are
sir,
taking as a book value
Chandra
only.
sir,
Absolutely,
just
sir.
hold, sir, just 1 minute. So what Chandra sir has said that Rule 11U is very clear that we should take the balance book value of all the other assets. So sir, coming back to our old discussion where you yourself has told that even though it is said here about the stamp duty value, but we need to take a practical approach. So that flows for the other assets as well. The rule has a clear if a boundary which needs to be maintained.
Correct.
Sir, let me complete in all humble submission. So we need to maintain and respect that boundary with respect to everything. However, as a practical, see, the client, if you say that, okay, no, I will just sell it at the book value, the client may or might not agree. So if you have a reasonable reasoning with you that, okay, for other assets also, we are not taking the book value because of this particular situation, then you are free. And trust me, you are free to the extent you are able to explain to take the other value of all other assets or certain other assets as well. This is where you start as a base. Today, the purpose of discussing these rules are that this forms the base of our calculation. But however, this being strict, if this had to be strict, then this had to be strict in terms of immovable property as well. However, we as a consensus understood that this may or may not be strict in terms of a particular limb because of the prevailing market conditions. So that lays good for all other things as well.
Sir, with my humble submission is Rule 11 does not require valuation report, no discussions. Take balance sheet as in the transaction date. What are the values are there? Please take it. For those values, replace these values. What you discussed before. Those cases, though what is guidance value, I agree. Slight differences. If the market value is more than the guidance value, there is a differences. But I think other than this, then we don't have any room to intangible asset. Then even
so in valuation of immovable property, where is valuation report required?
No, we'll take guidance value. We'll take guidance value.
Okay, so then my point is our thrust earlier in this particular session was that no, there is a change, then we should take market value. What is the issue? There should not be any wrong to that extent. So that's why I'm just kind of carrying forward that discussion.
That is only, I know that even the deviation, but the deviation is benefiting the revenue, they will accept. That's what our understanding. Because ultimately, when you offer more than what is required, then I don't think they'll question it.
So
if the question they'll
in book value of assets also, you'll offer more than what is required.
No, not correct. The law, then we cannot. Sir, what? Tell me, Rule 11 is there a need for a valuation report from an independent?
There is no need for a valuation report in immovable property.
Chapter over. Then only take book value of assets. Summation take 4 values. Then I cannot even for a kind of deferred tax asset, those things, everything. Though it's the intangible, it is an it's a book value. There is no value, but even then, according to me, deferred tax assets also we cannot remove. Though logically no value, but the law says take book value of all assets and liabilities as on the date. Take these 4 values. So. Yes. So that's what we have done in a couple of cases. The same thing only we have done.
Agreed, sir. Agreed.
Sir, Ayush sir.
Yes, sir.
Sir, can you help in opening this 11UA is useful for section 50 CA, right? Any other sections that is used for income tax?
Sir, seller's limb 50 CA. No, like I told you, the rule 11U double A is specifically dealing with 50.
11UA. I'm talking about 11UA. We are going to calculate.
The 11UA is for all the transactions. Why I'll tell you? Because for all the transactions there is a purchaser's limb, and when there is a purchaser's limb, all the purchases as far as the capital asset is concerned is governed by section 56.
Is purchasers or section sellers? So can we open section 56 of income tax, sir?
Yes, sir. I'll just open it.
Because the concern about what value 11
56 Sorry? Is for purchasers. 56 is for purchasers, what we have discussed.
Purchasers, sir. Purchasers, sir, right? Okay. So essentially what it is saying is purchasers should not pay below the value, it can pay above the value. That is the intent of this particular section. Right? It does not talk about whether the seller's capital gain, what is the impact, it is not talking about it at all. So
no, it is not saying that, sir.
So therefore, section 56 is asking that seller should not pay obnoxiously low value, low price. Therefore, it is trying to get a minimum value. That's why there is a prescribed rules. As long now the belief is the seller is going to get to the true value and buyer is going to pay, and the true value determination, if buyer and seller are coming in collusion, income tax doesn't want to lose. Therefore, they are saying minimum you pay as per 11UA. That's the principle, right? So 11UA is a hard-coded rule where there's very less flexibility for the people to play around.
Correct.
So as long as 11UA, so whenever you say whether it is the immovable property or jewelry and all, as Mr. Chandra is saying, we have to take everything as a book asset minus specifically 4 items. In these 4 items, The market values is what the rule prescribes only for these four assets technically. But
Right.
market is not something which is outside the individual's choice. This is market price. So they try to define the market price. For example, for quoted share, they define SEBI. For jewelry, they defined by the wealth tax, whatever they come in. Similarly, for immovable property, they said guidance value. So these are the
Right, sir.
prescribed. These are the only four entries where we are saying other than the book value, we should put a number.
Correct.
Now, the guidance value is a reference point because in all these transactions, the actual immovable property is not getting sold. It's only notionally we are saying that if it gets sold, what will be the value?
Correct.
If it gets sold, what is the value? The reference will always be what will be the adjudicating authority value this particular asset if I were to go and ask him to value.
Correct.
And that value will typically be the stamp duty value. Because guidance authority cannot say that I know last two transactions went higher, so I'll put higher number.
So obviously, they will not go by your market.
So therefore, it's always the stamp duty rate which is applicable by the guide, unless if there's a structure on the land and which is a half completed structure, there is no specific value. One has to derive that value, which is some flexibility. So given this, we cannot, even if you have purchased, even if the seller has purchased the property at 4 crores, theoretically an immovable property, if the guidance value is coming at 2 crores, so be it, it is 2 crores. If the guidance value is coming at 6 crores, so be it, at 6 crores, to arrive at a value which is used for the seller to pay minimum. It does not reflect the buyer to pay the minimum. It does not talk about the capital gain for the seller and everything, because none of this section talks about.
So there is 50C to that extent.
I'm coming to that. Now we'll come to 50CA. Can you open 50CA?
The CA.
No, I think 50CA essentially talks. That's why I said my understanding.
50CA talks about shares being sold.
Yeah, what happens is when the company is being sold, unlisted entity, they refer to the full value consideration. So in other words, if the company's share value is arrived at 48 rupees by the fair market value through 11UA, and if someone is selling at 40 rupees, then it is a deemed understanding that the share price is 48 because fair value is 48. That's the understanding of section 50CA.
Correct.
That is my understanding of 50CA. So 11UA is largely a prescription for the minimum price at which a seller has to buy, a buyer has to buy and seller has to sell.
Correct. So having understood, sir, now let me summarize. So what you have said is essentially the summary of what we have discussed today. As you might remember when we started it, I agree 100% to what you have said. This forms the base, number one. This is the minimum which is being prescribed. There is no way kind of guiding you that this should be the only price. This can be higher than that. This can be lower than that. If it is lower, then there are certain taxabilities which is in place. However, this works as a guidance force or a, if you, as you rightly pointed out, the minimum valuation which is required to avoid any kind of deeming taxes.
And therefore, sir, 11UA, as Mr. Chandra sir is saying, is hard coded. You do not have flexibility saying that I would take market.
To this point, I understood what you are saying, that we need to abide by the things which is written. I agree to that. But what in certain cases, in certain of my submissions, we have been able to successfully dwell before the income tax authority that there are certain practical assumptions or there are certain practical notings which as a valuer, when we see from our naked eye, is not kind of covered, because income tax cannot cover all the scenarios. So there are certain scenarios which are otherwise not covered, however is being mentioned in and now let me take you a very good example of this. Supposedly we are selling an unquoted share. This particular client has recently developed, and this is one of, and it's good that you shared, so I'm able to kind of share another practical example which I dealt. this particular client of mine, while selling the while selling his company, had recently developed a proprietary technology which was unique in its own kind. But if you see in books, there was no value. But the client, while selling it, will try and find out a value for that. So the client,
which is fine, sir. The problem is assuming the book value was 100 in your example, actual value is 10 crores. The problem is the seller is going to pay 10 crores. Buyer is going to pay. Buyer is going to pay 10 crores.
I'll tell you whether again, just let me complete. So if the buyer in this case was a foreign entity, so the foreign entity will not go by your words. The foreign entity will want a valuation report to that extent to prove that it is not 100 rupees, it is 10 crore rupees.
So the question is, again, what valuation is 10 crores? Understood, the buyer is going to pay 10 crores. The question is, income tax is only concerned whether it is paid more than its value. The minimum value is 10 crores, book is only showing 100 rupees. Doesn't matter, income tax is very happy any which case. The question, where is the question of income tax being unhappy? So
that's what I'm said. That's what I said, that in that case, even if you value it at 100 crore rupees, income tax will not raise a question on you.
No, you cannot. No, the question, no, it's not. So income tax, okay, the difference is as follows, sir. Unfortunately, and there are many prescriptions and orders to that extent. So 11 UA is hard-coded, unfortunately, good or bad. But the purpose is very limited for 11 UA. It's saying that it's a minimum guidance bill. It should be above this. The 11 UA is brought in to ensure that people do not cheat on the minimum value. People go below. The purpose of 11 UA is very different. The 50 even 50 CA was only from that angle. Because if people are going below this, let me consider full value as 11 UA, whatever it comes in. That has come in. You need to see saying that as long as the buyer is paying the above the value, I'm fine, and then it's a true value. I have no issues. If the books now, whether 11 UA should be revamped to incorporate new things. Recently, 11 UA got amended to bring in venture capital method and all that stuff. Earlier, it was not there. That's a change that income tax has to bring into the table. But today, as we speak, there are many prescriptions where there is no flexibility. For example, in the DCF method, when someone tried to use certain projections independently, income tax tribunal has stated very clearly, the projection should be, income tax said the actual projections taken by the management are lesser than what it is, and the income tax tried to raise a demand on the SSC. SSC went to the appellate tribunal. Appellate tribunal said nothing doing. The SSC has used NAV method, income tax used DCF method, something like that. Then the income tax appellate, no. The choice is for the SSC. If he feels NAV is giving him a lower value, he will use NAV. The true value through DCF, in your case of IT company, the true value DCF would give you a huge value, but NAV is giving lower value. The choice is again with the SSC. Income tax appellate, that's the choice he has. You cannot change the method. That's very clear. So the belief is that and I'm sure, and I could be wrong and corrected, when you have stated that we have flexibility, to the best of my knowledge, sir, there's no flexibility because the rule only prescribes the minimum part of it. And the second aspect in the entire thing is you refer to the balance sheet. The balance sheet you referred, if I understand correctly, you said that if there's no balance sheet drawn, you can go back to the previous audited balance sheet. I think, am I right, sir? Is that what you stated, sir?
Yes.
If you see carefully, valuation date suppose is November. Last balance sheet is 31st March. Are you saying that you are going to use 31st March balance sheet? You are supposed to draw the balance sheet. It's a mandatory requirement that you draw the balance sheet on November when you're doing the valuation.
So there is no mandatory requirement.
So can you please open Can you please open 11 UA again? The rules, that explanation that you have said.
Just open.
And there are many other experts in this group. I'm the least of it in the income tax part of it.
No, sir. We all are students of law, sir.
So
it's not about you or me being.
Yeah. Can you open that explanation?
Else for that
Yeah. All of us are learning, sir. Can you please open 11 UA, that other part?
The balance sheet of such company as drawn up on the valuation date.
One second. The key word is as drawn up. Okay, next.
And where the balance sheet on the valuation date is not
drawn up. The question is, you are supposed to draw the balance sheet as on valuation date. The only premise here is they said that not enough. So when you said the second part is applicable, in most of the time what happens is you have to draw the balance sheet when you're trying to do the sales transaction. Okay. If you do not draw the balance sheet as on that date, for example, you take the jewelry part of it. That's where you gave the example here. I have as on the balance sheet date, I have a jewelry of 100 grams. And when I'm doing the valuation in November, I sold 90. I have not drawn the balance sheet. I cannot value the entity as on 31st March 24 reference numbers. So what it says is you have to draw the balance sheet. Now there could be scenarios where you don't draw up. Suppose, for example, you are doing a valuation as on 2nd April and 31st March is the audited balance sheet. 2nd April, you're doing the transaction. Hypothetically, so just hypothetically. Probably there's no material change. You don't draw up the balance sheet. Probably from that angle, this is my assumption. From that angle, they have used this.
No. I'll correct you to this extent, sir. What you have said is correct that you should draw a balance sheet. However, if you are not drawing a balance sheet on that date, then also the previous audited balance sheet, see, there is a word attached to that. Drawn up as on a date immediately preceding the valuation date, which has been approved and adopted in the AGM.
Yes, that's what I said.
So let me complete, sir. Let me complete it. So even if you are doing on 2nd of April, and or maybe rather than 2nd of April, say on 10th of May, where the books of accounts have been audited of that particular March as well. But however, if that has not been approved and audited,
agreed. So there's no second thoughts on it.
Secondly, what the point which is being referred to as the last balance sheet day does not mean to referring to the quantity as well. It means referring to the value. Supposedly, like you told about 100 grams, and out of which 90 grams you have sold. So you will take 10 grams only, but the value will be on the last balance sheet date. So jewelry is not applicable, but otherwise for any other asset, say for inventory or any other asset, supposedly you had 10 units of your inventory, out of which 8 units you have sold. So for the balance 2 unit, you will take the value on the last balance sheet date.
Yeah, so
you will not take it for 10 units. That is where the practical understanding as a valuer needs to come in place. That cannot be written in this, but where the reference point of the balance sheet is being referred to the last audited financials.
Yeah, so yes, sir. So essentially, again, I'm just sharing some thoughts, and there are some judgments already came up on this. You have to draw the balance sheet largely. There's no second thoughts on it. And once you draw up the balance sheet, it becomes an unaudited balance sheet. As you rightly say, it's not an audited satisfy. It doesn't satisfy audited. But what it says is for the valuer, he can still do the valuation using the unaudited financials. But the company eventually has to do the audit also as on that day for it to survive that particular valuation for income tax to accept. So, but for the valuer to do the valuation and give a valuation, it need not be audited as on that date. But that should not be.
It clearly says, so then again, if you're talking about hard coding of this particular section or rules as drawn up on the valuation date, which has been audited. So correct. As your working document, sir, you need to have the audited document.
Exactly, sir. This is where what the interpretation of the law had come in. It said that for the eventually the value, it has to be audited balance sheet. If it is 11th number audited balance sheet. 6th September, 6th number audited. However, the one who is giving a value at the time of giving the valuation report, it need not be audited. So what does it mean technically is, technically it means that I work on provisional financials, I give a report, eventually later it gets audited. If there is any material change in the audited report versus provisional financial, this valuation report that we gave has no relevance. The presumption here is the management representative says that. So it's not something I'm saying.
These are all litigation. I'll tell you, sir. These are all litigations. I accept. See, if you go into the litigation zone or if you go into judgment zones, then there can be a lot of ifs and buts which can be placed here. So I agree to what you are telling that okay, ideally there should be a balance sheet which needs to be drawn up. However, all those things. See, I'll tell you. Like if I tell you this particular is maybe probably 100 words, but this has an interpretation which is beyond this 100 words. So obviously
Yes, sir.
there will be various circumstantial issues which will be there and which you need to apply based on case laws, based on your understanding and based on your interpretation. Probably you do something which might form a reference point for other case laws as well.
Certainly, sir. Certainly, sir.
So agreed to that. So that I'm not going into that zone as of now,
Yes,
because
sir.
that is a different zone altogether of what is a practical approach, because that depends on a valuer to valuer, case to case, company to company, client to client. There are lots of permutations and combinations based on which your approach to Rule 11 UA or Rule 11 U or Rule 11 UAE may or may not differ.
Yes, sir.
However, the law
Yes.
has given you a base on which you need to work upon.
Yes,
Ideally,
sir.
that is the thing which you need to kind of satisfy, and you need to abide by that. If you are deviating from it in any circumstance, you should have a proper justification or reasoning to that.
Yes, sir. Thank you, sir.
I
Thank you
think
so
that
much.
summarizes what we have been discussing, sir.
Yes, sir. Thank you, sir.
Yeah, thank you so much.
So if any further question,
I have a question.
Yes, ma'am.
I want to know who can issue 11 UA report. I am also company secretary by profession and a registered valuer. Am I eligible to issue 11 UA report?
Ma'am, wherever there is a specific thing written like an accountant or a merchant banker, there only accountant or a merchant banker can do. Otherwise, any particular registered valuer registered under Income Tax Act can do it. It can be an ordinary company secretary as well. It can be anyone.
My specific question is, for 11 UA, can I issue or not?
For 11 UA only I am telling, ma'am. In 11 UA and 11 UE, there are certain parts which is being written as being done by an accountant or a merchant banker. If it is written there, then only an accountant or a merchant banker can do. If it is not written, for all balance cases, any registered valuer registered for the purposes of valuation under Income Tax Act can do.
No, sir, our question is, specific question is, if I understand correctly, Rule 11 UA report can be issued only CA or merchant banker or registered valuer. Madam, for this answer, we discussed earlier several times. Rule 11 UA is not a valuation report. That is a method of calculation of valuation. So any person can give registered valuer, chart accountant, company, even management can prepare. See what is there in the balance sheet. Take four values, take guidance value, summarize it. So there is no valuation report is required. However, as a good management wants some independent report, that's not preferably valuer being knowing all the provisions. Either he will be the best person. So otherwise, strictly speaking, it can be even management also can prepare on their own.
Management, see, I'll tell you, sir, two things about that. As I said, what I have said, wherever there is written a merchant banker or an accountant, they need to prepare. However, where there is nowhere written, anyone can prepare. That is what I am even saying, sir. However, as you have only rightly said, for it to be a see, management can otherwise prepare. So I'm leaving management aside. Apart from management, who can prepare? They need to be a value. See, these are valuation rules. So this nowhere means that it is not valuation rule. So that understanding to that aspect is limited to what we are trying to perceive. However, these for this or for a particular valuation to make in place, one has to be a registered entity under that act. So to my understanding, a CS doing this 11 UA without being a registered valuer under Income Tax Act will not have a relevance as far as the report in front of an adjudicating authority is concerned. You can prepare it. There is no bar in preparing any report. Even a layman, a normal person can do it. But its applicability or its relevance or its acceptability is the question which is there.
Shilpa, sir, with your permission, sir, can I make some statements, sir? Shilpa has been asking 2-3 times on this. With your permission, sir.
Yeah, please, sir.
Shilpa, specifically to your question, well, 11 UA, even I have issued it and I am not a chartered accountant. Neither I'm a company secretary nor am you are aware of it. So, but I have issued it as a registered valuer. Two things, as Chandra sir is saying, it's a report, anyone can do it. Now, income whenever you are issuing report within that sections. For example, if there's a land and building comes in, then that particular part you have to outsource to a land and building valuer. You cannot take the guidance. Similarly, if the jewelry comes in, because it specifically says it has to be used by an expert of jewelry, you cannot do the value. You have to outsource that to jewelry. But because it is a per share value, as a registered valuer, you can use it, but you have to outsource individual activities. If a stock in trade, which is coming in the inventory, but it has a real estate part of inventory, whether you can value directly or you need to outsource part of it to the real estate value, that's ambiguous right now. But otherwise, because it's under inventory, you can do the valuation. So from a report perspective, you can do the per share report value. Individual pieces of that report, you have to outsource it to other persons. It doesn't say that it has to be registered with income tax, to the best of my understanding at this stage. Apart from that, the other parts where it specifically says merchant banker for the DCF approach, that you cannot do it because, and where it talks about the securities other than the equity shares, where that part they specifically it says you have to use some DCF other method, that also you have to outsource it to a merchant banker. So, or salary accountant, I think. So those pieces which are specific where you have to outsource, you have to outsource, but overall report you can issue by taking their inputs. This is my understanding.
Here I have a query. As Mr. Ayush was also specifying that guidance value, if I know the right way of calculating guidance value, can I take the guidance value, or for that also I
No,
need a...
so this you have to go to the see. This is a challenge which most of us are facing. If it is a pure land value, land and building asset, okay, it is classified immovable property. Issue is not about whether you can take it. Issue is under the code of conduct of registered valuers. It doesn't come under your asset class, so you cannot do the valuation even though it's just a multiplication. You have to outsource it. The challenge is when it is in the part construction. When it's a part construction, it comes under the inventory. Now, inventory has to be valued by registered values under SFA class. However, it's a real estate component involved. So now in this case, since you know the guidance note, can you just do this because it is coming under inventory, or you have to outsource? That is ambiguous. When the fees is less, people do it on their own. When the fees is more, people outsource it. That's a technical part of it. But someone has to clarify on this. So, I mean, that's the only thing which is little ambiguous at this stage, to the best of my understanding. And eventually, as Chandra sir is saying, all these reports are used by the management as their report, some reference point. Now, income tax only when it has a challenging some thoughts, the fundamentals of it, then only it comes to whether they are accepting a report or not. Because even if a CA gives in, or even if any other person gives in, if the report is not giving a true picture, income tax is going to challenge it. Otherwise, they accept it. So if the registered value is able to give a true picture in this entire thing, it doesn't matter who gives a report because the rule says that anyone can give a report. That's the principle behind.
Okay. Thank you.
Yeah, thank you.
I think we can end the session now.
Yes.
Yeah.
Vijaya? Are you there, Vijaya? I request Mr. Chandrasekhar to formally extend vote of thanks for today's speaker. Mr. Chandrasekhar, are you here?
Yeah. Thank you, Shilpa.
Yeah.
And today, the Dasara festival, morning, we had a very excellent interactive session. So now most of the times we have a speaker, he speaks only one way, and people less interaction. But today I think it is a very, very interactive session, and some of the points even that we may not agree for certain points, but speaker has a different view, and the participants with our equal view have different view. But ultimately, so what are the so with this I thank speaker for his excellent initiating a deliberation and also for taking time. I also thank BVA for organizing this session on this festival day also without any break. I thank one and all. Madam, anything is there? Momenta is there?
Vijaya, are you there?
Yes, ma'am.
Yeah, most importantly, it is the 100th session and it's very memorable. And thank you, BVA, for organizing it on a very auspicious day.
Once again, I would like to request all the participants to come on 18th October 2024 on at ICMI Institute. This Valuation Day celebration is being organized in association with IBBI. So that could be a wonderful opportunity. I'm sure IBBI, office bearers could be coming in. So please do not miss this opportunity and request you all to block your calendar and let's meet in person on 18th October 2024 evening. Happy Dasara. Is it anyway better now?
Shilpa ma'am?
Is it better now? Am I audible?
Yes, ma'am. Yes, ma'am.
Yes, you are audible.
You are audible.
Yeah, I hope you all heard me about the Valuation Day celebration.
Yeah.
Yes,
Yeah.
yes.
We announced the venue also.
Yeah, ICMAI RVO, Baswan Gudi. Okay, everyone. Thank you all. Happy Dasara.
Thank
Happy
you.
Dasara.
Can I end the session, ma'am?
Yes, Vijaya.